Investing always has to be linked to financial goals. Because if you're not going to link it to a goal, how do you know where to invest? One of the biggest questions is that why do I even need to have equities, when gold can give me that return? But actually, when you look at long term returns on gold, right, you see that gold only outperforms equity 30% of the time.
Do you think SWP is the way to go for financing through your retirement? What's your view on that?
What content we are seeing on SWP needs to be clarified further. SWP is not to be done from an equity fund. You need to do it in a debt fund. So it's not a wealth building tool. Of course, being a financial advisor, I've tried out various other investments, and I can tell you in hindsight, all of this other stuff does not actually make you money. Most investors make a much lesser return than the actual fund returns. That's simply because they don't remain invested. But there's one fund that I've held since 1999. A year before the goal, look at trying to protect as much capital as you can, because you know that you have this goal coming up. You don't know how markets are going to be in the next 1 year.
What's your view on India's growth story for the next 3 decades?
Absolutely.
Hi Mrin, welcome to Power Up Money. So good to have you here. Mrin, you come with decades of experience of advising people, corporates, non-corporates, everyone. And I would love to pick your brains on, how people in different stages of their corporate lives invest and how do they make money. For context, our audience is this 30-year-old someone who is just started off making on this wealth building journey. So insights from this conversation will be really helpful for those to be on that path. So I think let's start with that, and across your many years of experience, let's start with what are the key differences that you have seen in the investment playbook of the three kind of corporate professionals. I usually divide in three categories. One is that early professional, second is the mid management, and third is leadership. How do you see those differences?
So Navda, thank you for having me on your podcast. And yes, I think the three basic life stages that you talked about. I think what really changes is your family situation during the life stages, right? I think as people get into 30s and get more responsibilities come on to them, and they're at that point in time, I think people are starting to get more serious, especially in case if they start a family, then of course the seriousness suddenly comes in.
Yeah.
And all of that. And I think when people are in 30s, they do start looking at more how can they do better with their money, how can maybe look at some more longer term things as well. And certainly by the time you're in your 40s and your 50s, then you're actually hit by this big realization that, oh my God, I have so many goals to fulfill, I have so many things to take care of, and how do I even start taking care of this because of the financial life that I have led.
Right.
A majority of people today are very unprepared for retirement, or I would say even a majority of people are like really unprepared for any of their financial goals.
Right. And I think a key change that I see from my previous generation is I think retirement is no longer till 60. I mean, people are now becoming, I would say, redundant in their mid 40s, so you have to be prepared for it. So what's your view on this whole FIRE movement that's starting, right? The retire early, or rather, being the financially independent part. Do you see that happening across different age groups?
I think people do want to get financially independent, but a very small percentage of people actually end up getting financially independent. And in fact, there's this person whom I know who took early retirement, and he was a very successful career at leadership level. And he was telling me that when he actually put in his papers, so many people came up to him and actually said that we also want to do this.
Okay.
Right? And they said the only reason that we are not able to do this is because we don't have our finances in order. Right? And this person, actually, when he took the early retirement, he still has responsibilities, like both his kids are teenagers studying. So he still has responsibilities, but he's been able to do it. And again, this person basically has made income through salary only. So I think very few people are actually able to get there.
Yeah.
And a majority of people really rue about it because, you know, they're like, we just cannot do it only because of financial reasons.
Yeah. And in your experience, right, what's that key thing that differentiates people like him from others, like the vast majority who are not able to do that?
I think two things. One is having some good guidance. So I do know that that person was working with a financial advisor. The other thing is listening to the financial advisor as well. And it's like, you know, listening, you know, like listening to your doctor or listening to
Yeah.
your trainer all the time. And the third thing is really remaining committed. I think that's the most important thing. Like, see, even if you don't have an advisor, honestly, you know, the bigger aspect is that you need to remain committed to this whole goal or this pursuit of financial independence.
Yeah, no, very true. And as I was mentioning, right, I mean, in the financial freedom stories that we do, my key observation has also been, I think, wealth creation is not rocket science. I think it's pretty simple and straightforward. All you need is commit and just stay disciplined and on the way. So I would love to double down on each of these, you know, different phases of corporate lives, and would want to understand, you know, what is the right investment strategy in each of these phases. And let's start with, you know, the first 5 years, because I think they form the fundamental blocks of how you sort of make that relationship with money. What's your view on that?
Yeah, so I think when you're starting off, you know, while of course it's the time where you've had freedom to spend, and I think you should enjoy that. Try to at least save 25 to 30% of your take home income and invest that money. And you know, while retirement is really far away, that's one thing that you have to put away some money for, because
Right.
there's no loan at retirement and you're going to have to take care of yourself, right?
Correct.
So start investing some amount for maybe for the short term, and of course you need to put away some amount for the long term, and that amount that you're putting away for the long term has to be into an aggressive instrument like equities that can compound in the long term.
Right. And what particular equities would you recommend for a person who is, say, in their late 20s and sort of saving for the future?
You know, Navda, I always recommend mutual funds. I mean, I want to tell you, I myself, the only reason I was able to start my company 10 years back was because I was financial independent. I didn't have to borrow money from anywhere. And I want to say this, that the one instrument that actually made money for me was mutual funds. So at least my own financial independence journey has been due to my mutual funds that I started investing, by the way, in 1999. Okay.
Wow.
Yeah. And you know, so I would say do equities. Don't get swayed by all the things that you'll see around, like for example derivatives, F&O, or this intraday trading. And so, and also if you see, there's a report from the regulator which shows that 93% of people who individual traders make losses in F&O, right? And more than 70% of individual traders in day trading also make losses.
Right.
So just stay away, you know, do the simple stuff, and that should put you on the right path.
Right. And even within equity, because you said, you know, for a person in late 20s, retirement is still very far off. So would you suggest more mid and small cap heavy portfolio?
Yes, very much.
Got it. And do you think there's any, because there are also some short-term needs, right? I mean, if I put my feet in the shoes of a 20-year-old someone, it could be higher education, it could be wedding, etc. What instrument would you suggest for this kind of person?
Well, you could look at the ultra short term funds or short duration debt funds, but basically debt funds you could look at. If it's above a year, you could look at arbitrage as well. But yeah, I mean, basically I would say the safer instruments that are there, of course, not equities.
Got it, got it. And how does this allocation change as you progress through in life? What is the pattern that you have seen, and what would you suggest?
So I think, you know, as you progress in life, I think you need to get a structure around your financial life, right? And the first thing is, of course, to have the emergency fund, right? So that if there's any emergency, like there's a medical emergency, there's a job loss, or let's say there's a big repair or whatever it is, right? You're not trying to wonder where do I get the money from, right? Second thing is to take care of financial security, which is to have enough life and health covers, right? And, you know, I know a lot of people, you know, during COVID, if you remember, everybody was out there trying to take health insurance, but now most people have forgotten it, and again, one of the surveys that we ran at FinSafe was with employees on how well are you prepared for medical emergencies.
Yeah.
And most people actually said that they are just relying on the employer provided covers. Now, we
Yeah.
know today with everything that we are seeing in the job market, that just relying on the employer provided health cover is not, or even life cover is not the way to go.
Right.
So I think it's very important to assess the amount of insurance that you need. There are lots of calculators available out there that you can look at to figure that piece out, and look at ensuring that you're covered to the right amount based on your family's needs. These two steps are like really important
Yeah.
before you actually start investing, right? And see, the third thing is that investing always has to be linked to financial goals. Whether it's 100 rupees, it's 1000 rupees, a lakh, a crore, whatever the amount is, it has to always be linked to a goal, because if you're not going to link it to a goal, how do you know where to invest? So let's say you need money after 3 years and you see equity markets are doing well. This is what most people do, right? You think you need the money after 3 years, you see equity is doing well, you just go and park the money there. But we all know that
It comes
equities
in
are not
cycles.
supposed to be invested for 3 years, right?
Yeah.
So it's very important to know, to plan your investments based on your goals, so that you're choosing the relevant investments for that time period, basically.
Correct.
Right? And of course, have a good mix of various asset classes. That's very important. Generally, I have seen either people are very low risk, so they'll have FD and that insurance and all, or they're very high risk, right?
Direct equity.
There are very few people in between, but what you do need to have is a good mix. And I typically recommend that if you have a mixture of short and long term goals, of course for short term goals, as I said, you have debt funds, but on the longer term goals, have at least 25 to 30% equity exposure for it to make a meaningful impact to your wealth.
Right.
And limit gold exposure to about 15%, right? Again, this year gold, we've seen how gold prices have gone, and one of the biggest questions is that why do I even need to have equities, when gold can give me that return? But actually, when you look at long-term returns on gold, right, you see that gold only outperforms equity 30% of the time, right? So it's really important that we look at data correctly. So this is typically what I would say for anybody who's 30 and above, right? Look at financial security and then invest based on goals, and have a good asset allocation between debt, equity and gold.
Got it. No, I think fair, and we all have this recency bias, right? So because gold and now silver is doing so well, everyone is like, okay, let's go for commodity. But I think having that balanced exposure and looking at data the right way in the right time horizon is very important. And because Mrin, you mentioned, on your financial journey that made you financial independent, tell us more on that. Like, how was your journey like? Where were you investing, and what was your mindset that sort of made you financially free 10, 15 years ago?
Okay, so one thing is, you can talk about all the things that you did right, okay, but I think one of the most important things was that when you make a mistake, make a course correction. So in 2008, we had this financial crisis and the markets had fallen. I had a whole lot of money invested in penny stocks.
Okay.
And I lost 70% of that money. But then I said, okay, this is not my cup of tea. I don't have the time to monitor this. So you know what, whatever money is left now, at least let me put that away in a mutual fund and take care of it that way. I think I'll talk more about one or two mistakes that I did. So I think one was not having enough equity allocation.
Okay.
And the other thing was not increasing the amount to be invested with the increase in your income. Right?
So were you always invested in mutual funds from the very start?
I have tried out of course, being a financial advisor, I've tried out various other investments, and I can tell you in hindsight that all of this other stuff does not actually make you money, right? So keeping your portfolio really simple, okay, and in an instrument that can give you consistently average return is what works, right? And for me, that really helped. So I would say, simple instruments which give you consistent average return, keep investing, keep increasing the amount that you're investing, and yes, have a good equity allocation. I think that's really important. There's a lot of noise about equities in the markets, right, among
Yeah.
people. But when you look at household data in India, we still have less than 10% at a household level, data
Correct.
level, there's less than 10% in equities. The other big aspect, which is a behavioral aspect, is to keep out the noise, right? There is data to show that most investors make a much lesser return than the actual fund returns. That's simply because they don't remain invested,
Correct.
right? And there's too much of noise today on other investments. I think the biggest thing that can really help you in your financial journey is to remain committed by going on investing and increasing
Yeah.
investment. But the other big part is remaining invested. I think the biggest challenge is going to be to keep all of this noise out, and that is why it is also very important for you to have someone to talk to.
That is true.
And
that is true.
have an advisor if you can, but otherwise have a circle with whom you can, just talk some of these things. Nobody is asking you
Right.
to divulge numbers,
Yeah.
but always nice to have a circle. And I say this especially for women, Navda, because
Yeah.
women don't manage money, and money is the last thing that they would talk about with their friends. So
Yeah.
I would always say have a circle that you can also talk to.
Yeah, and because you bring up that point on women not, actively handling their money, and I've also seen that across. Do you see that that shift happening? Like now, women are becoming more involved, and what would be your advice to women to sort of be on top of what is happening with their money? They may not manage it actively, but what would be your advice to them?
The shift is very minimal, unfortunately.
Even till today, you feel?
Yes,
Okay.
even today, the shift is really minimal. And I see that women are not confident about talking money at all. Being financially independent is not, it's not being portrayed in our environment as sexy enough. So if you ask me today, money is the most important thing.
Yeah.
Right? And if you are not talking about it, and if you are not doing anything about it, you're not going to have the life that you want to have.
Yeah.
Right? And I would actually say for women, please you don't have to wait for a celebrity to come and say that financial independence is important.
Yeah.
And these are people who are so accomplished in their
Exactly.
careers. Like
I feel like they're
surgeons.
earning money, but then they are not understanding money, and it just sort of saddens me to
It's a
see
mind
that.
block.
Yeah.
It's a mind block to not want to understand money and to say, okay, if this is one thing I can give away to someone
Yeah.
else to manage in the family, and this whole this whole social mindset that men can do it better.
Yeah.
So I want to tell you, in all my when I was an advisor, in all my advising journey, I have had only male clients, and I can tell you for sure it's not that men know better.
Case in point. And I think, and I really hope conversations like these can sort of bring a change. In fact, I remember doing podcast with a woman, a mother, who was again very financially aware, and because of that she could take her maternity break without even thinking twice, because she had her corpus to cover her for good 2 years. And I'm so glad I had that conversation. So I hope more conversations like these can sort of bring in. So coming back to your journey and your portfolio, right? As you were talking about being disciplined, so what, like at the time when you became financially free, how was your portfolio like? And particularly because you mentioned mutual funds. Now there are 5,000 mutual funds out there. What is your strategy to pick categories and even fund schemes? Do you have like a framework there?
Yeah, so I stick again with very simple categories, right? On the debt side, it's basically ultra short term, arbitrage, or short term funds, depending upon the time frame.
Okay.
On the equity side, it's a very simple index large cap. So large cap fund invested through an index fund, mid cap fund, small cap fund, flexi cap fund. I don't look at any other categories because you don't need to.
Or
No, you don't need to, because any sector or theme that has potential, or where the fund managers have a high conviction, is going to be there in the broad-based funds in any case. So you don't need to take a concentrated bet and get into a sectoral or a thematic fund. So I just believe in these four simple categories to basically invest your money in. And I believe in both active and passive. So, as I said, do the index fund for the large cap, but flexi cap, mid cap, small cap, completely actively managed funds.
Okay.
And you have some great funds out there that are consistently again beating benchmarks that you can actually look
Yeah.
at.
So is there, for the active funds, is there some framework, like 2 or 3 things that you check before picking a actual fund scheme?
there are a lot of parameters that you need to look at, and there would also be qualitative factors that you would actually consider in terms of, you know, how have they, you know, what are the sort of calls that these funds have taken and stuff like that, right? So, you know, I don't want to give, like, you know, while recently I think the information ratio is one particular number that's been mandated to be talked about, but, you know, just looking at that alone cannot help you take a decision, right? So it's very important to take the right, choose the right funds, certainly not based on the last 1 year performance, but on longer term performance, right, and within these categories,
right. No, and very important point on, you know, sort of we have this habit, and, you know, I remember we were doing a survey with our users where most of them just stick out to the same fund for the rest of their lives. They never exit. But, you know, as you said, the cost of the top and the not performing fund is huge. So what's your strategy of exiting a fund, you know, because in the course of time you would also want to rebalance and churn. What's your framework? What's your strategy like?
I don't want to name the fund, but there's one fund that I've held since 1999. Okay, and there were very few funds then. So it's one of the top equity funds in India, and I've held it since then. You know, talking about exits, right? So you would exit a fund for 3 reasons. 1, rebalancing. 2, underperformance. And 3, near a goal, right? So on underperformance, what I would say is that, look, when you do your reviews, right, you know, funds do go through cycles, right? And just because this fund, you know, there are other funds that have done better in that particular year, it's not a reason for you to exit, right? I think, you know, you should always track a fund for 12 to 18 months, and only if you're seeing consistent underperformance, then look at exiting.
Okay.
I do see this tendency a lot, and especially on my TV shows, I get a lot of these questions like, I invested 6 months back and now this other fund is doing better, so should I exit, right? No. You know, when you're in equities, it is for the long term. The ups and downs, not only markets ups and downs, but, you know, in our own lives we have up and down, right? So we can't expect that, you know, just because I invested in this fund, it's always going to be the best. We ourselves are not the best always in our lives, right? So that's 1, right? 2, rebalancing, right? So for example, when your debt equity allocation has changed a lot and you feel the need to rebalance, so you say that, okay, my equity allocation has grown and I would like to bring it down, you can look at rebalancing then. But again, ideally you want to then exit the non-performing funds, or you want to exit the funds where you have very small allocations and stuff like that. So that's another reason to exit. Now, exiting near a goal, right? Exiting near a goal is something that you really need to plan out well, right? So if you remember March 2020, COVID, right? Markets had fallen 38%. There were so markets had fallen 38%, and fund returns, 5-year SIP returns were down from 12% to 1%.
Correct.
And a lot of people at that point said, oh, I have to withdraw the money because I have to pay for my child's education or for whatever reason. And they said, you know, we were banking on this amount had grown to this, and now it's back to the principal amount. So what do we do now, right? And it is actually to protect yourself against situations like this, that when you have invested for a particular goal, it is extremely important that at least 1 year before the goal, you look at the value of your investment and look at withdrawing some part of it to protect that particular capital for the goal.
Okay.
So let's say that, you know, you've saved for your child's education, and let's say the amount is, your target was 25 lakhs and let's say you are at 24 lakhs also, right?
Yeah.
I would still say exit.
Okay. But partially.
You can exit the whole, I mean, you can exit the whole amount. If your amount is higher, of course, exit the whole amount.
Okay.
Even if your amount is lower, maybe you leave some amount, and it's very subjective, you know, there's no like right or wrong in this. All that I'm trying to say is that, you know, a year before the goal, look at trying to protect as much capital as you can, because you know that you have this goal coming up. You don't know how markets are going to be in the next 1 year. So yeah, these are the 3 or 4 cases when you look at exiting a fund. And I have been asked this question, that is there a situation where you would never exit a fund? And my answer is yes. If you don't need it, stay invested, because you have reinvestment risk.
Right. Tell me more on the reinvestment, like choosing the right fund again.
I mean, you'll exit this fund, where will you put your money then?
Fair.
right? Then you have to search for another fund. So
Sure.
yes, if your fund is doing well, like an index fund, for example, right? There's no need to exit an
Right.
index fund. As long as you're happy with its performance and you don't need the money, it's fine.
Right. And this is more like a lump sum goal, right? So all the corpus that you made, you redeem and for a lump sum goal. But retirement as a goal, right? And I mean, we being non from the government, we don't have pension. So do you think SWP is the way to go for, sort of financing through your retirement? What's your view on that?
I'm so happy you asked me this question because unfortunately, I think, what we are seeing, what content we are seeing on SWP has a bit of, needs to be clarified further. So, SWP, which is systematic withdrawal plan, is the opposite of the SIP, where
Yeah.
you're basically withdrawing money on a monthly basis for your requirement. So, it's not a wealth building tool, right? It's a tool that's meeting a particular need of giving you an amount every month. That also needs to be planned. Secondly, it's not a wealth creation tool, right? It's a tool for you to get you that money every month. So you cannot put an it's not that you cannot, but ideally you don't want to do an SWP in an equity fund because equity funds are really volatile. So the first and foremost thing to always remember is that SWP is not to be done from an equity fund. You need to do it in a debt fund, and SWP is not a wealth creation tool that it's been brought out to be in a lot of YouTube content that I've seen. It is a tool for you to get a monthly amount that you need to use for your whatever needs that you have. So even the SWP needs to be planned. If you're going to go and put an SWP and then you're going to start removing money from it immediately, you're just removing your own money. You have to invest in that fund for a while. From a retirement perspective, one of the reasons that I have always recommended the NPS to people is, despite the lock-in, is the fact that Navda, I do a lot of retirement planning sessions, and one of the biggest challenges people face are, how do I plan for that monthly amount to come in? All right.
Correct.
And
that is where I thought SWP could be a good fit.
Yes. But what happens is that, of course, you have your fixed return instruments. But what happens is that, beyond a point, it gets like really difficult for a lot of people. And that's where NPS is very helpful, because in NPS you have a pension. And even in that 60% lump sum part, you can set up an SWP there. So your money remains invested, and then you're just pulling out what you need, right? And which is why I typically recommend NPS for retirement over anything else.
But my personal view, and because I don't invest in NPS, I always thought that investing, because I have a good time horizon in front of me, investing in an equity fund would give me better returns than NPS. So of course, lock-in aside, and as we said, up to 60, I don't know how much it will be relevant. Wouldn't you still feel that because of the returns, equity would be still a better wealth generating tool?
Yes, provided you stick on to that equity fund for the next 10 years or 20 years or whatever that period is. You don't jump in, jump out. So I'll just tell you the other side of it, that for most people, typically mentality kya hai, that you're getting this corpus and then you're going to put it in a fixed deposit or like some post office scheme or something, and you'll get that fixed return, and that should be enough. But that's not the reality today, right? And for most people, it's very, very difficult to plan out how to get that regular return. If you have an advisor, then it probably is easier, but then many people don't have advisors, right? So I think again, it's for each person, it'll be a different situation.
Right.
Yes, if you can remain invested in the equity and you feel that you can plan this out better for yourself and you want more flexibility, go the equity route. But if you feel that, okay, I find this very difficult and I just want this pension and this SWP to be set up and all that, then, and of course you're okay with the lock-in till the age of 60, then take the NPS.
Fair. I think it's more like, if you are self-disciplined, good for equity, but if you want like forced discipline, then probably NPS could be the way. So I think Mrin, lots of insights in the conversation today, and given your wide experience, right, what's like that biggest mistake that you see people doing? It could be across any life stage when it comes to investing. What's like that thing you see across life stages happening?
expecting returns to happen very fast. Yeah. And of course, chasing trends. Chasing trends is the biggest mistake.
Right. And what's your view on, as again, because I've always been talking about this different life stages of corporate employee, there are key events in life, right? Like home buying or maybe kids education, etc. How do you think, like how equipped are people in planning those, and what would be your advice to them? Because a lot of our viewers are in those life stages. What's your advice to them?
Well, I think first and foremost, use a goal planning calculator, which is very freely available on the internet, to figure out on an inflation adjusted basis what's going to be the value of that corpus, right? One of the biggest mistakes, so right now if I assume that it's going to cost 10 lakhs for education, people will save exactly that amount of 10 lakhs, but 10 lakhs 10 years down the line is going to be much more, right? So, first and foremost, use a goal planning calculator to figure out what's going to be the corpus requirement. And for that corpus requirement, how much amount you need to be saving every month, right? You also need to be saving the right amount. Often I meet people who are saving for children's education, and then their numbers are like completely out of whack. When people invest, they just think that this money is going to grow 10x very fast. And that doesn't happen. Another thing I want to say is most people earn very average returns of 8 to 10%. Everybody is talking this 10-15% returns, but actually when people come down to their portfolio and see the returns, actually it's between 6 to 9%. It's not even 8 to 10%. That's because what happens is that you have a majority of your portfolio in safe investments, right? So what I would say is that figure out first of all the amount that you need to invest. And of course, based on the goals, again, choose the right instrument. If you don't know where to put your money, just go and buy a Nifty 50 index fund and just leave the money there. If you believe in India, you believe in the India growth story for the next 2-3 decades, just buy an index fund and be done with it, right? Fair. So figure out the amount to be invested and choose the right instrument that can help beat inflation.
Right. And, as you spoke about if you believe in India, just opt for an index fund, just plain and simple. Given you have seen, the last 3 decades of India's financial journey, what's your view on India's growth story for the next 3 decades?
Absolutely bullish. Yeah.
Great. That's good motivation for all of us who are now investing in mutual funds. No, perfect. I think perfect note to end this conversation, Mrin. Thank you so much for taking out the time. So many insights. Thanks for all of it.
Thank you. It was lovely being here today.